Give me a sec. I'm going to try one more thing here. Participants. Pause. Share it. There's nothing on here that says that you're blocked. Well,
Well, they can answer questions or they can type in their questions.
yeah,
or-
I'll just have to keep the screen open so I can see your questions. The last couple are, we can type, so that's what we're going to do. We're going to go with that. All right. HECM, understanding the HECM for home purchase. What the heck is a HECM? HECM is an acronym for Home Equity Conversion Mortgage. It was created by FHA, and it basically, we'll go into the history of it later on in the presentation, but it basically works like an annuity based on your house. It allows seniors to either access the cash immediately or pull it out over time. The big key in these loans, what is really different about these loans is the monthly payments are optional. If a senior gets into one of these loans, they're not required to make a monthly payment. We're on a traditional, what we call forward mortgages, normal mortgages. The bank schedules those things, so you have a set amount of payments over 15 years, 30 years, whatever it might be. So that's what a HECM is. The term in the world, people call them reverse mortgages. Reverse mortgage is a much larger answer. A HECM is specifically the FHA loan. Reverse mortgages actually began way back in 1961. And I always like to kind of bring up the image of Bailey Brothers building and loan in the movie It's a Wonderful Life. That was a little building and loan. And that's basically where these loans got their start. There was a little business called Deering Savings and Loan in Portland, Maine. And the local high school football coach and teacher passed away. And he left his wife, a widow, and she had no money, but she had the equity in the house. And she really just wanted to live out the rest of her life in her house. So she went to the local savings and loan. And one of, I believe, if the story is correct, one of her husband's former players and students worked there. And they came up with the idea of the bank giving her a monthly payment every month until she passed away. And then the bank would sell the house and pay off the loan. And that's where they originally came from. That was the very first use of this type of product. Completely unregulated at the time. Then in 1969, Congress was starting to realize that eventually the baby boomers were going to get to be retirement age, and they were a wave, a massive human wave that was going to hit the retirement system roughly about the same time, or at least over a 20 or 30 year period. And an economist from California named Yongping Chen spoke in front of Congress and said, hey, you know what we need? We need a housing annuity that will allow homeowners to stay in their homes based on using the home equity that they had accumulated over the years to help supplement their Social Security or retirement funds. Now, I don't know if you follow politics or much, but Congress doesn't move quickly. So from 1969 until the 1980s, nothing really happened. But in the 1980s, Congress passed the first version of what we call a HECM today. In 1983, the Senate approved a proposal from Senator John Hines of a type of reverse mortgage to be insured by the Federal Housing Association. In 1984, American Homestead sets the foundation for the government-insured reverse mortgage when it unveils the Century Plan. Now, in the very beginning, when it came out, it was very loosely based. The government said, it told the private industry, they told the banking industry, hey, we need one of these. You guys come up with the rules and run with it. Banks really didn't know what to do or how to handle it, so they did the best they could. So in the very first days, and we'll get back to this later, the industry was a little wild and woolly because it was very loose. The banks could loan 100% of the equity or as much as they wanted to. It was, there wasn't a lot of guidelines because no one really knew how to implement this. So in 1987, they passed the bill. Actually, Reagan signed it into law with a Democratic Congress, and the first HECM refinance was closed in 1989. Back then, you could not do a HECM for purchase. That didn't come out until 2008. I don't know if any of you were doing forward mortgages, traditional mortgages back during the foreclosure crisis, but they tweaked some of the laws then, and very rarely will you hear me compliment Congress for adding laws. They tweaked the laws around the HECM and they made it better. They improved the product. One of the improvements was they came out with the HECM for home purchase. So seniors weren't just relegated to refinancing the home they lived in. If they wanted to sell that house and take the cash and then buy another house, they could use that equity and purchase a house using the HECM, which is really the focus of today's class. Reverse mortgages, the term alone freaks people out. And we like to use the analogy that mortgages are like breeds of dogs. There are lots of breeds of dogs. I have Basset Hounds, but Basset Hounds are built for comfort, not speed, whereas a Greyhound is the vice versa. They're built for speed and not comfort. Really depends on what you want out of your dog, the same as if it depends on what you want out of your mortgage. A traditional mortgage is, like I said, it's based on the bank saying, here, I will loan you this much money, I will attach a lien to your house, and I expect you to pay me on the first day of every month this amount of money, which will slowly deaden your debt, and in 30 years, your loan will be paid off. A reverse mortgage, the banks go into it knowing they're not going to get monthly payments. Their goal is to loan you money, and it's based on actuarial tables, like in the insurance industry. They basically have a pretty good idea on when we're all going to die based on our gender and our age. They know about, give or take a few years, how long most people are going to live. So the banks design the loan so they don't expect monthly payments. You're allowed to make them, but they don't expect monthly payments. The bank is expecting you to live to a certain amount of time, maybe a few years after that, at which point you're done with the house. You either move into an assisted living facility, maybe move in with one of your kids, or you pass away and your heirs sell the house, at which point they pay back the loan. They pay back what was borrowed plus the interest, and that's it. They keep whatever profits are there. The concept of a reverse mortgage throws people off, but you need to keep in mind, it is a mortgage like every other mortgage, the same as if two dog breeds, they're both dogs, they just have different attributes that make them attractive to different people. Fruit, it's the same kind of deal. There's lots of fruit. I'm a banana guy myself. I am not a pineapple guy. It gives me the willies, but to each his own. There are a million different fruits out there. It really depends on what you're looking for out of your fruit. This is what I was talking about a minute ago during the financial crisis of 2008. The bill was called HERA, Housing and Economic Recovery Act of 2008. And FHA is authorized to ensure a HECM for home purchase under HERA. In late 2008, they released a mortgage letter. Those are the things that kind of govern FHA loan programs, implementing the FHA HECM home for purchase program. And it also did several other things which made the loan safer. So we can get into those details later. Reverse mortgage in general terms are a type of loan that has no required monthly mortgage payment. They are not necessarily the FHA HECM type of reverse mortgage. There are a lot of them, and some of them are very popular right now. We call them portfolio loans because what it is the lenders who have typically service or create the HECM FHA one, the ones loan for the home equity conversion mortgage, realize there are people falling through the cracks, people that were probably good financial bets that they could offer a loan to, but they don't really fit into that FHA rule book. So they came out with their own loan program that's very similar to it, but a little looser in some regards. Typically speaking, people go into them because they are doing a jumbo loan, very expensive homes, couple $1 million, very popular on the west coast of the country, where most homes are $1 million and up. Seniors will use a reverse mortgage, not a HECM, to do their purchase or refinance of those homes. They also often will allow more access to cash. They have lower interest, mortgage interest, or not mortgage interest, mortgage insurance payments on them. And for you realtors here in the state of Florida, if you are familiar with trying to get an FHA approval on a condo, you know it's almost impossible. Whereas you can get a portfolio approval of a condo, meaning you can do a reverse mortgage on a condo. So it's a possibility. It opens the market up a little bit for you. A HECM is a type of reverse mortgage, not the only type of reverse mortgage. That's what we were just talking about. It is sponsored by HUD, meaning the Department of Housing and Urban Development are the ones who said, hey, we need this product. So we're going to insure it through FHA, the Federal Housing Administration, which basically encourages lenders and banks to create these loans and to offer them to the public. That's the whole point. HUD or FHA do not actually loan anybody money. What they do is they create a situation that encourages banks to do the work, and then they insure it, which really is the deal. That's what helps out the most. The HECM for home purchase, no required monthly payments. Whether a HECM for home purchase or a refi reverse HECM, the FHA program is the same. A HECM for home purchase, where the borrower puts approximately 60%, maybe 70% down, depending on the situation, to secure the loan, but then they have optional monthly payments on that other 40 to 30% that they borrow through the HECM. The reason it's not a set figure is because there's a lot of factors that go into it. The age of the senior is critical. Age has its benefits. The older you are, the more the program allows you to borrow or access of your equity. You have to start at 62, or at least one of two people in the married couple has to be 62. And then the older you get, the more they allow you to access. You could do a loan where one of them was 62 or older and one of them was under 62, but the math will always be based on the youngest age, because this is a deal where the bank is planning on not getting paid until the youngest person is done with that house. So all the math's going to be based on the younger of the two people. It might seem awkward, but that's the way it works. This math is completely based on when people are done using a house. So that's what they have to do. And again, optional mortgage payments for life. That is a huge deal. Right now, the economy, I'm sure I don't have to tell anybody, is tight. Prices of everything are going up. If you're like me, you're in your 50s, you cut back on something, you get rid of a TV subscription, pick up a second job. If you're a senior and you're on a fixed income, it is financially devastating to have the cost of living go up 50%. You might not be able to make your monthly payments. With a HECM, it allows you the cash flow flexibility to age in place in your home and maintain a decent lifestyle and pay your bills. I see this loan as a fantastic tool for seniors, and I like the fact that when we offer this, I work for the HECM Senior Home Financing and do these loans, and then I volunteer for the HECM Association. So I get calls all the time from seniors who are terrified, literally terrified, that they can't make their monthly payments, and they're paying their bills on their credit cards, which are going up in interest every month because the interest rates are going up. So they're stressing out, and this loan program is a lifesaver for them. And for those moving into the state of Florida, as you know, our growth in the state of Florida, real estate wise, is being driven by seniors who are fleeing some of the northern states or California with high taxes and very restrictive laws. So they're coming to the state of Florida and they've got a pocket full of cash, which is perfect to do the HECM for home purchase program. Really puts them in a good position for the rest of their lives. This class is specifically about the FHA HECM for home purchase. I've referenced the fact that there are lots of portfolio products, HECM parallel products. We're not talking about those. I just wanted you to know they are out there because you'll probably get questions on them if you start talking about HECMs. But the HECM, FHA HECM for home purchase is what we're talking about today. All right. when your senior client says, I don't want to pay cash for my, or I'm sorry, I want to pay cash for my house. What they're really saying is I don't want mortgage payments, because they have worked their whole life to build all that equity up. And they know that cash flow is everything. They're not saying I want to pay cash for my house. They're saying I don't want mortgage payments. When you have this conversation with seniors, a lot of times you can see the little light bulb go off in their head. At first, they might be a little standoffish about the idea. Well, no, I don't want to do any kind of mortgage. And then when you explain, you have the option to make payments if you want to. This just allows you to keep your cash in retirement accounts, investment accounts, other real estate, or just sitting in your bank so you have access to it. This just gives you more options. And then they open up and go, oh, I don't have to make more payments. That's really what I'm looking for. So it's really in how it's presented. Seniors should have access to their funds in retirement. That is everything. It literally is everything to a senior. We do loans all the time for seniors who are getting along just fine until the roof goes on their house, or the plumbing goes on their house, or the car blows up. And then they're thinking, wow, I have $0 in my monthly budget to finance anything. And even if I did, that's just going to put me over the top. I can't do it. What do I do? I'm going to give you a quick example. I did a loan for a gentleman last year. He was 87, I think. He lived over in Volusia County somewhere. Owned his house free and clear, no debt on his house. His total monthly income was about $1,100, right around there. It was less than $1,200. That was it. That was everything. That was Social Security and a pension put together. He was living for years on $1,100 a month, getting by because his house was paid for. All he had to pay for was his taxes, his insurance, but then you also have to pay for your Medicare and your prescriptions and your food and your utilities and everything else. But he was doing it. He was making it like a trooper until his homeowner's insurance company sent him a letter and said, hey, Bob, you've been a great customer for 30 years, but your roof is old. Even though you're not complaining about it, we know it's going to cost us money. So we need you to replace it or we're going to cancel you. So what do? You've got no money in the bank. The money he used to have in the bank, he had spent to take care of his wife while she was dying of cancer a few years before. He had no savings, and his monthly budget was zip. There was barely enough to pay what he had going on. And if he didn't have insurance, if there was an accident or the house burned down, he's out, he's toast, he's homeless. I showed him how we could do a HECM refinance for that gentleman and basically get him enough money to replace the roof and a couple other things, upgrade the air conditioner, and then have a line of credit for the rest of his life. So he really was in a much better situation. That's what seniors want. They want to be able to relax in their retirement and enjoy it and not stress about the bills every month. That's for a senior, that's everything. The down payment for a HECM for home purchase is approximately 60 to 70% of the purchase price of the house. That includes the closing cost, the mortgage insurance, the down payment that goes towards the house, all of it. There are a couple of factors that factor into that algebra, and one is their age, the youngest age of the borrowers, and two is the interest rate or the margin that is used on the loan. All these things together kind of factor in to come up with an amount that they have to put down. Roughly speaking, it's between 60 and 70%. We were just running some numbers yesterday for somebody on one of these, and it's still right about there. When the interest rates rise, it actually brings down the amount of equity they can access, meaning they have to put more money down. These loans a year ago were more like a 50-50 deal. You put down 50%, generally speaking, for your average senior, and you finance 50%. Now we're at put down 60 or 70% and finance 40 or 30%. So hopefully the interest rates will come back down at some point and we can get back to that. But as for now, you're looking at where it is right now. Rhetorical question of the day. How many homes to seniors could you sell if all of the homes were 30 to 40% off? That's really the question, because it might, as I was just saying a second ago, it's not as good as it was a year ago, but in reality, what you're doing is telling a senior, you can, if you've got $300,000 to buy a house in Central Florida, $300,000 is not necessarily going to buy you the house you want or the neighborhood you want to be in. but 400 or 450, 500 is going to put you where you want to be. So you could use your money as the down payment, do the rest on a HECM for home purchase, end up in a much nicer neighborhood, dream home, and not have to make monthly mortgage payments unless you choose to. That's the big key. It's completely up to the senior. HECM for home purchase mortgage is a non-recourse loan. Now, I know you guys are in real estate. Some of you might know what that means. Basically, what that is saying is, and I love to use this example, if you were around during the foreclosure crisis back in 2008, you will know what I'm talking about. People's homes dropped in value almost overnight, 30%, 40%, some cases 50%. Now, if you owe $200,000 on your house, and then the market drops over the year, and now your house isn't worth $200,000, it's worth $150,000, you still owe $200,000. If you were to sell that house or pass away and your heirs have to sell that house, they owe the difference. They owe that $50,000 that they're not going to get from the sale of a house, except with this, because it's a non-recourse loan, meaning that the insurance premium you pay when you get this loan covers the deficit, and there is no repercussion to the heirs or the borrower. If there's a deficit of $50, $100, $200,000, doesn't matter. The insurance pays the bank the difference. You don't get a 1099 at the end of the year saying you didn't pay us enough money. You don't get any marks on your credit. It's covered. The non-recourse aspect of this loan is a fantastic attribute that you need to understand, because a lot of seniors are very conscious of the situation they put their heirs, their children or grandchildren into. They don't want to put them into a situation where they're going to be burdened with a debt. They want to leave them something, some kind of attribute, some kind of equity, really. When is the HECM for home purchase or HECM for home purchase mortgage due? Great question. When you permanently cease to live in the property, meaning you have moved in with one of your children, you have moved in, your place of residence is now in an assisted living facility. Not if you go to a rehab facility. You go to a rehab facility, the whole idea is that you're going to rehabilitate, and come back to your house. It's when you stop calling that house your home. That's when you are supposed to start the process to pay the loan back. When the last remaining, it's a key part here, the last remaining spouse or borrower passes away. Husband and wife, typically speaking on the actuarial tables, husband passes away first, wife lives several years later. If they had a HECM, he passes away, she stays in the house, she's still in that HECM until the day she passes away or moves out of the property. At that point, the process needs to begin. Or, this is important, you fail to comply with the terms of the mortgage contract, which would be these very same as with any traditional forward mortgage product. You have to maintain your house. You can't be storing nuclear waste there. You have to keep it in some form of repair. You have to make sure the roof's not leaking and ruining the house. The house is the security on the mortgage, whether it be a forward traditional mortgage or a HECM purchase. The house is the security. You got to maintain your house. Payment of property taxes, homeowners insurance, and association dues. This is key. I've been doing this for a while now, and usually one people's objection is, well, I know somebody who lost their house after they got one of those reverse mortgage programs. If you don't have to make, I want you to work through this, noodle on this with me for a second. If the bank isn't expecting a monthly payment, why would anybody foreclose on you? You're not making a monthly payment. You're not missing a monthly payment. There's no reason to foreclose on you. People get foreclosed on in HECMs or reverse mortgages because they stop paying their property taxes, or they stop paying their homeowners insurance, or their HOA dues. Honest to God, you stop paying those HOA dues, those people will come after you. So those are the reasons typically somebody will end up in a foreclosure situation, because the bank, quite frankly, isn't expecting to get paid until you pass away or go into a home. The only way you're going to get foreclosed on is you're not paying your property taxes or these other deals. So keep that in mind. It's important. You will get an objection about that. That's, you know why? Because in the old days, in the Wild West days, when they first came out with this loan program, they were loaning people almost all the equity, very close to all the equity. And the senior would use it. They send their kids to college, take a trip around the world, who knows what, but they'd use all the equity. And then the year rolls around and these loans are not escrowed like a traditional mortgage where part of your monthly payment includes taxes and homeowners insurance. They can't do that because they're not going to get a monthly payment. So you have to pay, or your borrower has to pay the taxes and insurance on their own every November and whenever the anniversary of the homeowners policy is due. If you don't have the money to pay, what happens? These seniors spent all the cash. They had no income. It comes around time to pay the taxes and whatnot. And they're like, I don't have any money. And the bank is like, this was the deal we made. You were going to keep paying those things. We don't have the money to pay it. There's no equity left. We can't pull money out of somebody else's equity to pay it. So that's where the problems came in way back in the day. That's one of the things they corrected during the 2008 change, was limited a little bit of equity to hold back for emergencies for things like this. So HECM eligibility and requirements. All borrowers must be 62 years or older. Spouses under the age of 62, 18 to 61 will remain on title with full rights to the home. All right, we got that? One of them can be under 62, but they're not necessarily going to be part of the loan. They're just going to be on the title so they can stay there forever. We actually get this. I probably get this question once every couple of weeks. I get somebody that calls me, and one of them's in their 70s and one of them's in their 50s or 40s. I had one about a month ago where it was he was in his late 70s and she was like 45, and he was living the dream, very happy with his choice, but he really didn't qualify for the loan, but he was gonna get by, I think. Must have the right to live in this country or territory, i.e. you have a social security card or a number, but you don't have to be a citizen. And there's a whole lot of people that fit into this. And if you, as realtors, if you start thinking about some of the people you know who are from somewhere in Central America, South America, or the UK, we have a lot of people that fit that bill. So there's a whole opportunity for you there. What properties? This is a good one. This is basically like your normal FHA loan in this regard. Single family residence, including townhomes, villas, cluster homes, modulars, new construction. You need a certificate of occupancy being issued before you close the loan. Meaning you could be working on that loan the whole time, but you can't get to the closing table until you have that CO saying, hey, this house is now a home and somebody can live in it. Duplexes, triplexes, quadruplexes, which are phenomenal. We will get into that later because that is an investment opportunity for seniors. Condominiums got to be FHA and HUD approved, which is, I am just being honest with you, virtually impossible at this point, but not completely impossible. After the collapse in 2008, FHA basically closed off all of the people who were already approved and said, you can reapprove if you want to, but the condo associations don't like going through the process. And some of them just don't meet it. I had one fall out a couple months ago. Everything was beautiful, except for the fact that they, at the last stage of getting somebody approved to buy a condo in that complex, they had to sit in front of the board and do an interview. Well, that's considered discriminatory because the board could say, you know what, we don't like that guy. We're not going to let him in, which means they could not like him for reasons that fall under law as being discrimination. So we couldn't do the loan that way. I had to do it a different way. So the home must be FHA move-in ready, no fixer uppers. That is a different FHA program called the 203K Nightmare. This loan is for houses that are in nice condition and ready to roll into, or at least your average FHA approval must be. You can't have holes in your screens or broken faceplates on your outlets or pipes or anything like that. It's got to be in good shape. Manufactured homes are possible. You can do mobile homes and modular homes. They got to be after July of 1976, and they've got to be strapped down correctly. They got to pass all the same inspections. It is possible to do them. The key is, most important, they got to be on land that they own as part of the deal, because this is a real estate transaction. And in Florida, many of the senior mobile home parks are a case where you rent the lot and you own the mobile home on top of it. So those aren't going to work. But there's a lot of them. I'm not sure about Pinellas County, but there are a lot of them in Lake County and Orange County and Seminole County where you own both. You own the land and the mobile home. So you could do those. Down payment funds and sources. So it's pretty cool in this regard. Checking, savings, CDs, investments. Depending, if you're selling your home, you can use that. No seasoning requirement. Retirement accounts, withdrawals such as IRAs and 401ks. Funds from cash value and a whole life insurance policy, which people do on a regular basis. Selling of assets such as a vehicle or gold or, the family hot rod that dad's not working on anymore, things like that. And gifts from family or even friends, which we see this one more than any of the others, really. A lot of times the adult children will be thrilled that the parents are moving to Florida and buying a house that everybody can come visit, and the kids will pony up a few bucks as a gift, which works out quite well. Down payment funds and sources that are not allowable. Now, these are kind of no-brainers, but we're going to say them anyway. You cannot borrow the down payment. Can't do that. No home equity loan from your second home or the home that you're currently living in to do this. Can't do that. Any type of subordinate financing. Nope, not happening. First-time home buyer programs. Nope. Personal loans, can't borrow money from somebody. You can't even borrow money from your kid. If they're giving it to you, that's one thing. You can't borrow money to do this. Loans against anything like a 401k or life insurance, can't do that. No, all funds must be seasoned for 2 months. These are pretty standard lending rules. Out of pocket cost, HECM for home purchase. The cost and fees, FHA appraisals, 600 probably minimum right now. I bet I think they're running closer to 700, maybe 800 when we pay for them. HUD counseling, this is an important factor. It is a HUD rule, a federal rule, that you have to be counseled before we can start this process by a third party, meaning I cannot counsel the borrower as the lender. I cannot tell them who to go seek for counseling. I can give them a list of a bunch of counselors and they can pick from that list. They have to pay a $150 fee, usually somewhere around there. In California, it's as high as $300. But they get counseled on the specifics of their loan. The person that they choose to counsel them will contact the lender. We will send them an estimate and information on the specific program they're going into. And that counselor is trained to a certain degree in reverse mortgages and HECMs, and they will walk the senior through it, prompting them throughout the process to ask questions so that the senior fully understands what they're getting into. The federal government was very cautious about the fact they don't want people taking advantage of seniors. After doing this for a while, I fully agree with them. People are always taking advantage of seniors. So I've become, and I'm sure most people that do these loans are very defensive of seniors because they see people try to cheat them on a regular basis. So counseling is a big part of these loans, and that costs $150. Traditional FHA loan cost became part of the loan. Normal closing costs, the third-party fees. State of Florida is an expensive place. We don't have income tax. So we've got title, tax stamps, doc stamps, recording fees, surveys. It is, as you know, as realtors, it is an expensive place to do a real estate transaction. That is not because this is a reverse mortgage or a HECM. That is because Florida is an expensive place. God, I love Florida, but that's the truth. So the fees for anybody doing any kind of loan in Florida are a little high. What is different is on an FHA HECM, there is an MIP fee, mortgage insurance premium. It is 2% of the purchase price is paid up front. It's pulled out of the closing cost, added into the closing cost, so they don't have to come out of pocket for it. But they have to pay a 2% of the purchase price fee that is the mortgage insurance premium. Sounds rough. It basically encourages the banks to do these loans, and otherwise they wouldn't do these loans because they don't get paid on these loans for several years. So they needed a bit of encouragement. And they also, most importantly, they need to make sure that they're not going to get caught with their pants down if the economy turns south like it did back in 2008. So that 2% makes this program possible. So as expensive as that might seem, it is why it's available to seniors. That is the reason. No. HECM and financial planning, a beautiful marriage. Now, as I said, I've been doing these for a while now, and people often, once they understand the program, they might say something like, well, that's great for somebody who's struggling, but I'm fine. I saved my whole life. I've got a 401k, or I've got a nice pension from the company I worked for 40 years. I don't need this. I see no reason to do this. Well, financial planners have done a bunch of white papers in the past few years saying, you know what, that might not necessarily be true. Certified financial planners' thoughts. These are just kind of bullet pointed, but there have been exhaustive studies done. And the answer is nearly all educated, informed, certified financial planners love the HECM, and they are more and more coming in line all the time where they're like, ooh, if I use that right, that is a great tool for my senior clients. HECM Mortgage extends the financial portfolio out many years. Read that one again. The HECM Mortgage extends their financial portfolio out many years, meaning it makes their retirement basically increase. They have longer to use their retirement funds because if they add this in properly and use it correctly. Certified financial planners love the lack of required monthly mortgage payments because cash flow is king in a fixed income world. No monthly mortgage payments keep cash flowing into their retirement, and they can, meaning they can keep putting money into their assets that are that are increasing in value. It is a fantastic deal. I skipped my screen a little too fast there. So anyway, to use the HECM to delay drawing from qualified accounts. Very, very big deal. Lets that asset grow if they don't need it right away when they enter retirement. Hold on here. Interest on principal, interest on interest, and interest on taxes one would normally pay on qualified accounts. Just think about if you don't have to touch that, you don't have to touch your premiums, and you're letting it grow for another 5 or 10 years into retirement. Those are big numbers and make a huge difference and let that retirement last a lot longer. Only draw the minimum on qualified accounts at age 70 and a half. Delay Social Security income. That is a huge deal. If you take your Social Security income as soon as you're able to, you will end up drawing a lower monthly amount for the rest of your life. If you wait until you're a little bit older, then it increases up to 8% annual raise. This is a huge deal, and you can do that if you were to retire, but you still needed money. You could use your HECM to fill that gap. It is a great tool to really increase your retirement income for the rest of your life. Reduce the mandatory taxes on Social Security while working till the full retirement age, 66 or 67, and honestly, in the future, that very well might go up. So again, this is a valuable tool. Partially pay back the HECM loan each year for the interest deduction and regrow the line of credit. If you have a HECM, and this could be in the HECM for home purchase too, you put down your 60%, the house, you end up in the house for a few years, and you pay off a portion of that when you get a lump sum of money that you sold from something. That money goes into a line of credit, and that line of credit grows every year, completely unrelated to what the economy is doing. That line of credit is going to grow at the same rate of interest that you are paying on that loan. So your line of credit, your access to that money increases every year. Seniors love that. Additional thoughts from financial planners. Not having a mortgage payment gives option to the retirees to spend or not spend. And options are everything. That is, I talk to seniors every single day, and they feel trapped because they're on a fixed income, and an option is something they generally do not have to enhance their retirement or to provide for their family. If the U.S. has another housing crisis, this FHA loan will protect the client, their heirs, and the estate from any losses. It's a non-recourse loan. That cannot be stated strongly enough. That is a huge deal. During the foreclosure crisis back in 2008, I worked in the foreclosure crisis. I was a mortgage broker prior to that. During that period, the banks would hire me to repair and maintain homes. And I saw a lot of foreclosures and talked to a lot of people. And I'm telling you, this is a huge deal that I don't know if everybody fully grasps how important that is. Heirs usually sell a house when they inherit it. It's the cash that they want. I can speak to this personally. My wife does estate sales for a living. So when somebody passes away, they call my wife in and have her sell everything they can in the house and give the rest to charity so they can put that house on the market, lickety split, and split the money between the leftover heirs. Very, very few times does somebody want the house. And the people passing away, the seniors passing away, come from a different world. They come from a generation where everybody left their house to the next generation, and they often lived in them. It doesn't happen anymore on a very rare basis, very rare percent. Most of the time, the heirs want to sell the house and they want the cash immediately. They want everything liquidated in a fire sale so they can get that cash in their account as soon as possible. I'm not criticizing them. I'm telling you, that's just the way it is. So. Oh, there's a question from that guy in the red. Yes, sir.
Actually, it's from William Horn. If you don't have to pay a mortgage payment, is there an additional penalty?
No, it's not a penalty, but just look at it very simply. And it's a great question, William. Here's the deal. You're not making a monthly payment. In a traditional forward mortgage, every month your payment is divided up into basically 4 different things: taxes, insurance, interest, and principal. Typical monthly mortgage payment, a portion is going to pay the interest and a little tiny portion is going to pay the principal down. In a reverse mortgage, you do not have to make the monthly payment. So your principal stays the same and your interest grows. I'm going to say the ugly word of negative amortization. This loan will grow over time if you are not making monthly mortgage payments. Make sure you hear me. If you're not making a monthly payment, the balance, just like in your credit cards, gets a little bit higher every month. That sounds like it's a bad thing. Historically, based on FHA, who have been tracking this for very close to 100 years now, across the country, meaning hot spots like Florida and places that real estate never changes much, like in the middle of Iowa somewhere, the average appreciation on a home is about 4% a year over time, meaning there will be peaks of spikes, there will be valleys like 2008, but you are guaranteed that generally speaking, your home, no matter where you are in the country, is going to appreciate about 4% a year. Now in Florida, you know, especially over the last few years, we do more than 4% on average. So if your loan is growing at, say, right now, the interest rates are 6%. If your loan is growing at 6%, and you're in Florida and your home is appreciating at 6%, then the balance, the two balances are parallel. You basically end up, the appreciation covers the cost of the interest over time. That is, I mean, you can't promise somebody that because you don't know what the economy is going to do. And there could always be a 2008, depends on when you sell. Generally speaking, the appreciation in the home covers the interest that you're paying, and people still end up with a truckload of equity at the end. And they increase what they owe on the loan the whole time. It's really a beautiful thing. William, please let me know if that answered your question. Thank you.
Question or statement.
Is it possible? There's another one up there. Is it possible for heirs to take possession of the home and pay back the HECM? That is a great question. William, you're on fire, brother. All right. In the case that a senior passes away, right? Let's say the dad died a few years ago. Mom just passed away. Son says, you know what? I've always loved mom and dad's house. It's a great mid-century home. I would really like to keep it, but I got to do something about this HECM mortgage. Well, the way it works is you've got a 3-month window to start with that you have to kind of make a decision on what you're going to do. They give you, on a normal mortgage, if your parents had a normal traditional forward mortgage, which like 60% of the people that age still do, you got to be making that monthly payment every month when you're figuring out what you're going to do with mom and dad's stuff in the house. In a HECM, you don't have to make that monthly payment because it's a HECM. You do have to pay the taxes and insurance whenever they come due, but you've got a 3-month window where you can say, hey, okay, am I going to buy that house? Or am I not going to buy that house? Am I going to sell it? Or what am I going to do? And then at the end of that 3 months, you can go, you know what? I'm not sure yet. You can ask for another 3 months. You can do that 4 times. So it basically comes out to be a year. You can figure out what you're going to do. Here's the best part if you decide you want to keep that house, you have the ability to buy it, just pay off what is owed and keep it in your name. And you can get a 5% discount on it. You don't have to pay 100% of the value. You can pay 95% of the value, which is a huge deal. Tim, let me know if I explained that incorrectly, but I believe that's the right way to explain it. No. All right. Verify.
Before point of order.
I
I'd
can't
say
see.
we take.
Go ahead.
I'd say we take a 10-minute break.
I think it's a great idea. Everybody good with that? All in favor? Aye. All opposed? Be back here in 10 minutes. All right. Thanks.
Hello. Hello.
Hello, can you hear me?
Yes, I can.
How are you?
I'm good. How are you?
Very well. I just found the spot down here where I can allow people to talk if they unmute themselves.
Okay.
Well,
Have
that's
any-
good.
We're going to roll into questions in a minute. You're early, but if you want to ask anything, you can go ahead.
Oh no, I've just been following along and listening. I've never heard of this loan program, so it is very interesting to me.
Yeah, don't feel bad. Most people, even realtors, don't know about this program, and it cracks me up when I
Yeah.
talk to people and they're like, "No, I've never even heard of that." It's a secret, and it's a shame because whether you're doing the refi or the purchase, it is such an attribute for seniors, especially in the financial times we're living in today. They at least should have the option to look at it and go, I don't want to do that, but now I understand it. So, it's
I've
an
had a lot of people ask about the reverse mortgage program, so this is good to have another option for them.
Oh, very cool. Very cool. We'll go over in a couple of minutes. Oh, I'm gonna unpause my screen. Your screen is
Yeah, it got dark.
resume share. And can you see me right now?
I can see you. Oh yeah, I can see your screen, but it's showing
Oh yeah, hold on.
everything now.
Yeah, give me 1 second.
There you go.
Yeah. Hold on. All right. I'm going to give everybody a chance to come back. Actually, you know what? Hold on for just 1 second. I'll be right back. Hold on.
Okay.
See me, and I've set it up where they can talk now. All right, is everybody back? Good deal, good deal. There was a question while we were closing up there from Lynn Raymond about the Ladybird deed. And I'll be completely honest with you, Lynn, I have not run into this problem yet. So I'm going to let Tim, my coworker, a guy who has a CRMP designation, which basically means he knows more about reverses than anybody in the country. So I'm going to let him answer that one.
All right, so let's first of all explain what a ladybird deed is for those who don't know what a ladybird deed is. So a ladybird deed is a slang name for a life estate. Ladybird Johnson, so President Johnson's wife, is famous for this. So basically, a life estate means that as a person, in this case, a senior citizen, has decided to go ahead and give the ownership rights to someone else, with the idea that they can live there for the rest of their life, i.e. life estate. So a typical situation would be mom giving her 2 kids her property now before she dies, which would avoid probate. Now, there's pros and cons with everything you do in life. So there's pros and cons with giving your house away before you die. The protection is that you have the right to live there the rest of your life. Your kids, in this example, cannot kick you out. They own the property now. They're going to inherit it automatically by deed because it's a life estate. In fact, they own it now. And I'm going to say this one more time. Mom has the right to live there the rest of her life. Now comes time that she wants to mortgage her property, in this case, using a HECM reverse mortgage. But she doesn't own the property. Can she do a reverse mortgage? Can she mortgage her property? The answer is yes, yes, yes. But the kids own the property, which means the kids have to give her permission to mortgage the house that they own. And most kids will do it. most family support the reverse mortgage. You sort of think that kids don't want to give up their inheritance, but no one wants to be burdened, not financially, not physically, not emotionally. Most of the time the kids live far away, but even if they live right down the street, they've got their own lives. They've got their own kids. They got their own career. They're still building their retirement. So 19 out of 20 times, 95% of the times, the kids will be more than happy to sign off, giving mom the right to mortgage her property, especially reverse mortgage. Now, what are the procedures? The kids have to go through the mandatory FHA counseling. Since they own the property, they have to go through the counseling session just like mom does. And it's okay for all three of them in this example to be on the call asking questions. All three of them will be on the certificate of counseling. The kids have to sign a few documents acknowledging that there's a mortgage being placed on the home. And there's your answer. Lady Bird deed is the same as a life estate. And yes, we can do a reverse mortgage in a trust, in a life estate, and so on.
All right, great answer. You know what? It's a good time just to do Q&A. It's kind of take a moment and you guys ask questions, whatever questions you want. If I can't answer them, like I said, Tim's a CRMP, and that test is so hard that it's not written down. It's a panel interview with a bunch of other experts because there's only, I don't know, 60 or 70 of them in the country. It is a huge deal. They know everything about these loans. I know a lot. Tim knows way more. So now's a good time. If you have any questions at all about what this is and how it works. And I've turned everybody's microphone on. If you unmute yourself, you can speak. Don't be shy. I know you're sitting out there thinking, what in the heck are they talking about? What about this? What about my neighbor who's 85? Come on, you got something. Well, let me throw out a scenario. I was just speaking with another colleague, Don, who I think you might know on break. And Don said, make sure they understand that even though I keep referring to the refinances because they're a big part of what we do. A senior could, let's say they own their house free and clear and they really want that second home. They could refinance their primary using the HECM, take that equity, take that cash and buy a second home and have no monthly payment on it. Great opportunity as a realtor to cultivate clients where there weren't any in this current market. Great idea, phenomenal idea. There's also the investment deal. I don't know if any of you work with investors, but earlier when we were talking about the types of properties, what if you had a senior who just moved here, they've got a bunch of cash in their pocket from the sale of the home up north, but they have a pretty low Social Security income. Their monthly income's kind of tight. They could take that money and buy, let's say, both sides of a duplex or a triplex or a quadruplex and live in one unit as their primary residence. So now the HECM covers the financing for the rest of it, and they can rent out those additional units and take that income. So every month they're getting, in Central Florida, your average rental income is probably $1,500, $2,000, $3,000. You're getting cash flow of that every month. And quite frankly, you don't have to pay the monthly mortgage payments. You can if you want to, or you could pay a portion of it. You could pay the interest only part of it or whatever you want to do. No matter how you slice it, that is a phenomenal financial opportunity for a senior who is in a position to buy both sides of a duplex or a triplex or a quadruplex. It is a great idea. So you might want to think about that as you're out there trying to farm for some business. Any questions? All right, you want me to start calling on people individually? Is that what you're saying? All right, let's see some names here. Hold it on. Caitlin Santiago, how are you today?
I'm doing great.
Have you ever dealt with a HECM or a reverse mortgage?
No, I have not. I've been listening to everything that you've been saying so far, and they're quite interesting. I really like what you just said about the retirement plan with the quadruplex or duplex for a retiree.
I would do that in a heartbeat. I'm not nearly old enough to retire, but when I get there, I think it is a phenomenal idea. And seriously, in Central Florida, I think in where we're at in Orlando, your average rent for a 1-bedroom, 1-bath hovers around $2,000 a month. So
Yes, sir.
yeah, if you had just a duplex and you slept in one side and gave the other to somebody else, that is $2,000 a month coming in every month that you don't have to make monthly payments on. What a life-changing event.
And you don't have to make monthly payments on either side, correct?
Right. It's one big loan. You're covered. That is a phenomenal deal, you know? All right. Well, you have any questions?
I do not, but thank you for sharing all this information. I am definitely learning something new today.
All right. Good deal. Thank you. How about Kathy Abbott? How you doing, Kathy?
I'm doing good.
Have you ever dealt with one of these before?
I have not, so it's very interesting info. So I don't have any questions, but I would like to see like a numbers scenario.
Ah, all right. We'll try to get to that. That's a good point. Good point. Honestly, I got to tell you, the math, when you start messing with these things, looks like voodoo economics. It's an
I'm sure.
It's a little crazy, but it makes sense when you boil it down to the basic idea that these are based on a life actuarial table, how long you are probably going to live. And that's the fundamental part of this plan. You know, it sounds harsh, but the bank is loaning you money and they're not going to ask you to give them monthly payments for a very long time. So it's not an unreasonable question or way to base the loan. How about Kenneth Gonzalez? How you doing, Kenneth? Kenneth's the guy watching Game of Thrones right now. What's happening on there? Anything interesting?
No, I'm fine. Thank you. Thank you for asking. I'm actually driving, learning a lot.
Oh, I picked the one guy. I don't want you to have an accident, man. You have any questions?
No questions. No questions.
All right, good deal.
Thank you.
All right, good deal. Okay, I guess we'll keep going. I don't see any questions written. Oh, wait, hold on. Okay, verifying a client's credit, income, and assets. This is where these loans really actually do get a little bit different. If you're familiar in your real estate career with the way traditional mortgages work, these things are underwritten from an entirely different standpoint. We look at your credit, we pull your credit report, but your credit score is really irrelevant. There's a gentleman I work with, another Sean who teaches this class, who brags about the fact that he got a HECM approved, and I think the husband and wife had credit scores around 350. Now, if you're familiar with credit, you know that to get a credit score of 350, you have to try. That doesn't happen on accident. You have to create a plan and really try hard and stick to it to get down to a 350, and to have both of you at 350 is really quite, you deserve an award for dedication to a cause. But they got them approved. They got them a HECM because we don't really care what the score is. Like traditional financing, that is a huge deal. The score isn't important. When you underwrite a HECM, you want to know, one, do they have the ability to pay their taxes and insurance at a certain amount? There's a formula used to figure out how much they need every month to pay living expenses, groceries, medical things, all that stuff. There's a little formula, has a little dollar figure. $529 for an individual, 800 something for a couple. So you need to have enough money. Oh, there it is right there, 886, to pay those two things. That's what they're looking for. So they're going to pull your credit report and they're going to add up the monthly payments that will stay with you if we close a HECM loan. So if you have a car payment, for instance, or a bunch of credit card debt or things like that, all those things add up and go into the formula. The score is not important. You can have bad credit. You can have things like medical bills and things went wrong, but you have to be able to give us a reason that an underwriter will look at it and go, okay, that makes sense. They ran into a life problem. He was in the hospital. for several months, things got a little mixed up on the bills, whatever it might be. Has to be a legitimate reason that you can explain that this was an outlier and not the way you treat credit. That's what it really boils down to. The big deal is you can't have treated your home expenses irresponsibly. You have to show a mortgage history that goes back and shows you pay your payments on time for the house, or you pay your homeowner's insurance bills on time. Those things are important. If you don't pay those things on time, we can still do the loans, but they require you to create what we call a LISA or a LESA, depending on who you're talking to. Basically stands for a life expectancy set aside. It means they're gonna calculate you're 70 years old, your property taxes are X, your homeowner's insurance is Y. We expect you to live till here. We're going to add those two things up and come up with a number. And that's how much you need to set aside in equity to make those payments for how long we think you are going to live. That way, you're not responsible to make those monthly payments. It's not a bad deal, really, to set it up anyway, because it's just one less bill the senior has to worry about. The money is just already accounted for in your equity, and it will be paid out. So we call them life expectancy set-asides, and that's what they're for. Borrowers cannot be delinquent on any federal debt. Yeah, if you have a student loan or an old FHA or VA loan, or God forbid IRS taxes, those things will cause you a problem. But again, not the credit score. That's not the big deal. It's not what we care about. Income, it's not a debt to income ratio like it is for traditional loans. What we look at, and generally we approve people on their pension and Social Security or just their Social Security. What we're looking at is that you have enough money to pay the taxes and insurance going forward every year, and to make that monthly formula that they figure out that you need to have to pay for the cost of living. And it's a very low amount, much lower than most people live on. So it's very doable. I got the one guy I was talking about before approved, and he had a $1,100 a month total income, which is just hard. It's hard for me to imagine. There are people in this audience right now that spend $1,100 a month on Uber Eats. I promise you there's somebody here right now laughing. Hey, that's about what I spent last month on Uber Eats or Starbucks. So yeah, it is a very doable loan. It is designed to help your average senior, not necessarily your affluent ones. The sales contract. All right. Speaking your language now, fully executed contract of sale must be provided before the loan application can be printed. The contract should and must include the FHA mortgage financing box checked off, contingency for a home inspection, FHA, a mandatory clause, and real estate certification forms. Buyer chooses the title company, ideally. And let me tell you what, there's a good pausing point. HECM's, the paperwork is different from a closing standpoint. It's a lot of stuff that your average title company has never seen. When at all possible, doing one of these loans, you want to be the one to pick the title company, so your HECM lender can pick somebody that they have experience with. So you look good at closing, because there is nothing worse than getting to closing and having somebody who doesn't understand the paperwork start questioning all the paperwork as they're going through it. The people have gone through the process of getting one of these loans. They know what they're doing. It's all boilerplate stuff, but you want somebody with experience at the closing table doing it. And HECMs are unusual. They're unique. Not all title companies know how to use them. So, this is interesting. We use the HUD-1, where you guys use the different closing form. We use the old closing form that was from my early days in the mortgage business, which quite frankly, I'm affectionate to. Addendum. And if a change needs to be made on the sales contract, you got to do an addendum. We just do an addendum. That's it. It's not a big deal. Quite frankly, it happens a lot. HECM for home purchase transaction summary. Average age for somebody getting a HECM, average age for somebody getting a HECM is 72 years old. Seniors buy houses. Seniors buy houses in Florida all day long. I think they buy more houses than everybody else. You'd have to look in your stats, but they buy a lot of houses. and they don't necessarily mind having a mortgage anymore. The seniors, if you look at the baby boomers as a giant group, because they span several years. The oldest baby boomers, the ones that are in their late senior years now, they were very conservative financially. The next 10 years and 10 years after that are more open to financing options because they've been doing it their whole life. They get it. The minimum age is 62 for a HECM. Not both people, but at least one of them's got to be 62. It's better if they're both 62, because quite frankly, if one of them is much younger than 62, the math gets less advantageous. So you want them both to be 62. Quite frankly, most of the time they will be, and you can go from there. Trick questions. What is the maximum age for a HECM? Anybody can actually answer that. Your speakers or your volume is on if you'd like to throw that one out there. All right, there is no maximum age for a HECM. The HECM for home purchase loan benefit is calculated from the lesser of the sales price, appraised value, or the lending limit, which is now in the millions, which is a huge deal. Our FHA limits are different than your traditional forward FHA limits. We are a whole subsect of FHA. We have our own rules. HECM for home purchase is very different than traditional FHA loans. So if you're one of those realtors who's familiar with forward FHA, you have a little bit of an idea, but all the rules are different. All the numbers are different. So loan amount is based primarily on the value of the home being purchased, the age of the borrower, and a little bit has to do with the margin we use in the loan, but not much. For homes greater than that amount, they can buy it. They can buy a $2 million, $3 million house. The difference is the loan will be based on that maximum lending limit of the $1,089,300. Example, age 72, HECM for home purchase price or a lending limit of that equals the HECM benefit, age down payment. There you go. It's a math problem. I call it the algorithm. It's a little twerky, and I run everything through the computer to make sure I have them right. Purchase a home worth over $1 million using FHA for HECM for home purchase. Love the Austin Powers slide. That's a huge deal. I mean, people think of FHA, a lot of times they think kind of the lower end of the economic spectrum, I'll say. That is not true. These are a phenomenal tool for affluent seniors wanting to buy or refinance that $1 million, $1.5 million, $2 million home, which quite frankly, Florida is loaded with now. They are everywhere. So it's not as unusual to have $1 million home, and it's certainly not unusual to see seniors coming here from one of the great white north states or California with a pocket full of $1 million to buy their next home. And you can, or even if they have 500,000 or 750,000, you can put them into $1 million, $1.5 million home with no monthly mortgage payments. That is a huge deal. We did an estate sale in the Villages, and the Villages has several homes that are in that $1 million range. And I'll tell you what, they are very nice. And seniors love the Villages. So anything more than that dollar figure, your clients just need to pay. They can come out of pocket for it. So you can still just finance that amount and use their cash for the rest. And we calculate the numbers for there. I mean, it makes sense. Understanding and applying marketing efforts toward your senior demographic. This is very interesting stuff here. Going to be a bunch of bullet points, but it is important that you understand these are all real and true. 10,000 baby boomers turn 62 every day in the United States, and it seems like they're all moving here. 1,000 people of all ages move into Florida every day. That is net. That counts the people that are moving out too. 1,000 people a day move here net. 24% of the home buying population of Florida is 62 or older. Think about that. 1/4 of the people buying homes in Florida are 62 years or older. I talk to realtors on a regular basis, and I swear to you, I hear this answer on a regular basis. But I don't really deal with seniors. And I'm thinking, are you stupid? I'm not really entirely sure about your marketing savvy. The 1/4 of the people buying are seniors, and they've got the most cash. I'm not sure if you are a solid marketing person as a realtor, if you are not targeting realtors. Think about it. 35% of all homes in Florida last year were sold to seniors age 62 or older. That is a huge number. 1/3. 40% of the US population age 60 or older plan on moving in retirement. And it goes without saying, they are all moving here or North Carolina or South Carolina. 77% of the nation's wealth is controlled by seniors. That's from AARP. They don't lie. 77%. And you know, if you're a millennial or a Zoomer or even a Gen Xer like me, you know that's true because they have all the money. Cash buyers, man. These people are your best target client. If you are not targeting them right now, you should be. 86% of seniors want to age out in their home. Again, something I hear daily when I speak to seniors. They don't care about anything as much as aging out in their home. A good friend of mine is a Korean War vet. He's like 90 years old. He's having some medical problems. His daughter called me the other day to ask questions about this program. And she was trying to figure out what he wanted. I said, he wants to live in his house until he's done living. That's what he wants. Use this to help him do that. And you're doing your job as his child. And she was like, you know, I think you're right. That is exactly what he wants. So reasons to target the senior market. A better retirement lifestyle for seniors equals happy clients, more referrals. It's true. And once they get them, they love them and they talk amongst themselves. I mean, they love to share the fact that they are in a good deal. And the reason they have the ability to play golf 4 times a week is because they did this loan. A friend of mine who did this loan long before I switched from forwards to reverses tells me all the time it was the greatest decision he ever made because it's allowed him to live a fairly comfortable lifestyle and pay for his wife's long-term care needs, which are wildly expensive. He thinks this is the greatest invention since electricity and loves it. So your seniors will brag about you for you assisting them in getting into this. Ideas for promoting the HECM for home purchase include helping retirees right size. I love this term. I believe Tim coined this term, right size, rather than downsize. Everybody thinks that seniors want to downsize. They don't necessarily want to downsize. A lot of seniors want to move into, again, a place like the Villages. They want to live into their dream house. They want to move into a place that is maintenance free, like a townhome or a condo or a villa, and it's close to a golf course and shopping and friends. They want to move in to a comfortable place to spend their retirement years. They do not necessarily want to downsize into a little bitty tiny apartment, but they don't know that there's an opportunity to use this financing to help them achieve that goal that they only see as a dream right now. But with the power of this loan program, you can help them achieve that. Real estate professional advantage. The HECM for home purchase will separate you from the competition. As you know, from the client we were just talking a minute ago, a lot of realtors don't even know this program exists. It is like a secret out there. And some of the people who know it exists only know the dark side of it. They've heard urban legends about people losing their homes in the past. So they think it's voodoo economics and they try to stay away from it. Huge mistake, huge mistake. This loan on paper, white papers from educated people far smarter than me, prove that affluent, intelligent, financially successful seniors use this loan to increase the length of their retirement accounts. This is a great opportunity to separate you from the other realtors who are not looking for an interesting product that will help them target 30-40% of the market that's paying a whole bunch of money and buying the houses. And the people that are for these seniors aren't worried about the job market. They're retired. The only thing they're worried about is that getting as much money and length of time as they can out of their retirement. And you can help them do that using this program. It's a great deal. Advertising homes for one large down payment and no monthly mortgage payments. That is a great option. Even bringing it up to seniors so they know they have an option is a great deal to separate you. You can get more listings. You can talk to, like we were saying a few minutes ago, you can talk to seniors and say, you know what? I know you've been looking, you'd like to sell in this market where it's still high, but you don't think you can't buy because your money's not going to buy you an equal house. Well, now it will. It'll buy him a better house. Sell in this market, you got the listing. Buy a better house for them, you got the purchase end of it. You got two transactions helping a senior achieve their dream. This is a phenomenal opportunity, and I think you should look into it. Even more reasons. Help your clients increase their retirement income and get a sale using it. I think we just went over that. I got ahead of myself, apparently. Suggest a HECM refinance on their current home. Wow, it's like I knew this was coming. It's so weird. I've done this before, but it's been a while. Increase your retirement income. Have a senior home buyer client purchase a duplex. We talked about this. This is nothing short of brilliant for seniors. And I don't think anybody that I know of in the real estate market has been targeting this, but if I was a realtor, I would do this in a heartbeat. I would go to the investment clubs. I would go to senior centers. I would be preaching this from the tops of buildings. You can help them be the coolest senior on the block if they have got $2,000, $4,000, $6,000 a month coming in and not making payments on it. That is, it almost seems too good to be true, and it's not. Oh, somebody's raising their hand. Hold on.
Yes, can you go back to the last screen real quick?
This one?
Let me see. I'm doing screenshots,
This
so
one. Hold on.
that one. Yes, sir.
Okay, you need it for a screenshot, or do you have a question on it?
It was a screenshot. I'm trying to make
I got you.
copies so I can go back.
It's a good idea.
Thank you.
All right, going to the next one. Anybody else have a question? Not missing anybody? All right, good deal.
I've got, so Don Mulcahy wanted me to bring up the non-borrowing spouse in particular.
That is a great
So
thing.
yeah, and in particular, a particular story, because we've all heard the horror stories of reverse mortgages, and that's one reason we separate reverse mortgage from HECMs. HECMs is the FHA type of reverse mortgage, where reverse mortgage itself is just a generic term. So the HECM is a type of reverse mortgage. The HECM is the safest reverse mortgage on the planet. Again, it's sponsored and insured by FHA. Since the inception of reverse mortgages, or the HECM reverse mortgage in particular, in 1988, signed into law by Reagan in 1989, they've always been a refinance, and you had to be 62 and above to do the loan. So if you were married to someone under 62, well, that person at that time was not part of the deal, was not on title, not on the loan, not part of the deal. And some of the horror stories that you may have heard about reverse mortgages have come from the old laws when it was sort of the Wild West, as Sean mentioned before. In 2014, FHA made some sweeping changes. Not only did they change the future of reverse mortgage to make them even safer, but they also grandfathered people in prior to 2014. So anybody who has a reverse mortgage, and by the way, over the years, there's been well over 1 million reverse mortgages, HECM reverse mortgages completed. 99% of all reverse mortgages are the actual FHA HECM. And there's some very good proprietary reverse mortgages out there. But in particular, the FHA HECM says that if a non-borrowing spouse, whether they were truly a non-borrowing spouse prior to 2014 or an eligible non-borrowing spouse post 2014, it doesn't matter. It's the same rules. They are protected from displacement. So if you've ever heard a story where one of the two people have passed away and the other spouse gets kicked out of the house, they got foreclosed on, the spouse became homeless. Those stories in the past, going back 10 years and beyond, may have been true, sadly. But today, once again, even the old reverse mortgages, everyone got grandfathered in, nobody gets displaced because of a HECM reverse mortgage. The non-borrowing spouse is protected.
Very good point.
And one more thing, Sean, if you're interested in telling a story, I love your pizza guy story.
Oh, I love that story. I'm going to tell a quick story that's unrelated to the slide that's up here. But when I started doing reverses and HECMs, I was actually going through my cell phone looking for somebody else's phone number. And I saw a phone number from a gentleman I had done a traditional forward refinance for like 15 years ago. And we got to be kind of friends, stayed in touch loosely. I hadn't talked to him in several years, but I saw his name and I'm like, oh my gosh, Gene would be perfect for this loan. Honestly, if he's still around. I mean, I don't even know if he's still around. I've talked to him a few years, but let me give him a call. I called him a few times. He didn't answer. I stopped by his house. I talked to him. Gene was 78 years old last year and delivering pizza 40 hours a week at Domino's. 40 hours a week delivering pizza, 78-year-old guy, to pay his bills, make ends meet. And so I get him into the program. He understands it, but he's still a little apprehensive the whole time until one day he has that aha moment where we're at closing and he fully grasps how good this is. And he looks over at me at the closing table and he goes, man, Sean, I got to tell you, this loan saved my life. And I go, well, Gene, it's going to make your life easier. You don't have to schlep pizza 40 hours a week. He goes, oh no, I'll probably still do that. I like working. He goes, my doctor told me over a year ago, I had to have my prostate operated on and I haven't done it. He said, if I take off work for the surgery and then 2 or 3 weeks for recovery, I'll be a month behind in my bills. And it's only a matter of time before I lose everything. I can't do it. So I just have never got the surgery done. So now I'm getting this done. I'm going to go ahead and schedule it. And I stay in touch with Gene. Honestly, we talk once every couple of weeks now. He did the deal. And fortunately, even though his plan was to keep working full time, the Domino's he works for cut everybody's hours in half. He would be toast right now. He wouldn't be able to make his bills. He's had his surgery. He's doing much better. This loan is, as far as I'm concerned, one of the greatest things out there. Very few times in life do you get to do something for a living where you help people and get paid for it. Win-win, great deal. Lots of stories like that. So I'm gonna move on unless somebody has a question. I don't see any hands up. The ethical and moral implications of the HECM for home purchase mortgage. Never upsell a home to a client that can't afford it. Remember, there are home maintenance costs, homeowners insurance, property taxes, and even association dues. And I fully believe that. I'm fiscally responsible as a person. I generally don't like financing, even though honestly, when I'm a senior, I will most likely be doing this myself. So yeah, you want to treat your clients with respect. Treat them. What I do is I try to treat them like I would treat one of my parents or an older friend, because the decision you make in using this product affects their life drastically. Usually it is a wildly popular thing and you're doing the right thing, but don't abuse it. So anyway, don't have a client downsize their home just because the world says downsize, which is true. Everybody seems to be focused on the downsizing thing for seniors. They don't necessarily want that. A lot of times today, they want a larger home so they can move in adult family members, maybe a son or daughter who's raising a grandkid by themselves. See that on a regular basis. So yeah, downsizing is not necessarily the answer. Right sizing, the correct fit for their lifestyle and what they want and what they're dreaming about. That's what you want to be worried about. Your senior clients needs to be aware of all the home buying financing options available to them. And that's true. I mean, you're a realtor, you know, there are 100 different loan programs out there. You've got mortgage people knocking at your door all the time to get into your business. And there are a lot of great mortgage companies out there. Most of them offer the same things, the VA programs, FHA, traditional stuff, conventional, jumbo, first-time home buyers, all that stuff is great. HECM is just another club in your golf bag of financing, and you need to see it that way. It's not for everybody, but every senior should at least know it is a viable option to improve their life. So keep that in your club, in your bag. What are some options for using the disposable cash? Gifts to children, family, huge deal. Funding for college for your grandkids, that is a huge thing. I mean, as you're a senior, you would like to see those grandkids use the money while you're alive, not after you're gone. So pay for their college. You'll be the biggest hero in the world. You could set up a legacy if you want, some kind of charitable institution. Help children purchase their first home. Today, more important than ever, because it's difficult for people to purchase their first home. Healthcare, Long-term care insurance. Wow. Seniors, this is a very expensive deal and one of the probably the highest uses of HECM financing. Transportation, a new car, very expensive to buy a new car. Even quite frankly, crappy new cars today are expensive. So seniors would benefit by doing that. Pay off debt. I don't know how many seniors I talk to on a regular basis that had a reasonable amount of debt until a year ago when the economy started going off the rails and interest rates are going up and things got real expensive. And now they have a lot of debt. So it's a great option for that. Remodel the home, add a big game room or family room so the family comes and visits more. Go have fun, take a trip, take a lot of trips. Tim takes one trip every, I don't know, 3 or 4 weeks. So take many trips as you want. Take vacations, see the world, take the family with you. Helping our seniors have the best home at an affordable cost. It feels great. This is one of those, I've worked, like I said, in the mortgage field for years, and I've always been lucky enough to have clients that were happy with my service. But you do this for a deal and they will come hug you. I did a loan for a sweet old lady in Daytona, and she didn't really need the money. She was doing fine, paying her bills. She was a retired librarian, had a cute little house in Daytona, but it was at the end of the COVID shutdown nightmare, and her family hadn't all been together in one spot for the whole 2-year window. And this was a huge deal to her. It was devastating to her. So she contacted me and wanted to do a HECM, honest to God, just so she could get enough money to pay for everybody in the family to come home for Christmas. And she did. I put her in a HECM. She got enough money. She bought tickets for everybody in her family. They all came home. She hugged me so tight, it physically hurt. And she was about this big, little bitty old lady. It made her day. It made her year. She was so happy that I was able to help her put her in this loan program. Because not having a house payment the last 30 years of a senior's life will have a staggering effect on their quality of life. That is true. And a lot of seniors still have forward house payments. Maximize your marketing power using the HECM for Home Purchase Program. Sold. Get the conversation started. We believe that real estate professionals need to focus on selling homes and not selling the HECM. Don't be a HECM expert. You need to understand the HECM, but for God's sakes, don't try to be a HECM expert. These things are complicated. Quite frankly, they're so complicated that I work in an office with people that do this all the time. And every couple of days, somebody says, what do you do if you run into a client that has this? Because there are a lot of scenarios. It's very complicated. However, we do feel that real estate professionals need to get the conversation started about the safe FHA HECM and using the HECM for home purchase to close on more sales, which in this market, you need as many sales as you can. So I agree with that 100%. Here are some tools to get the conversation started, meaning have your buyer ask you about how they can purchase a home with no required monthly payments for life. We have listing flyers that we can create for you that are home specific. So if you've got a listing, we can kind of create a little deal with all the math on it and gives them an intro, and it definitely will pique their curiosity. We can do those for free. Social media exposure, no cost. We will then email you a PDF and a picture JPEG version of this flyer so you can post it on your social media sites as well as your Facebook page, LinkedIn, any of those other things. Brochures, display boxes, we have all kinds of stuff. We really have, quite frankly, a bevy of marketing things so we could help you with. Approved wording and supplements for MLS, very important. MLS is very strict on their wording of things. No cost. Florida's various MLS services have approved special wording to be included. We've already gone through it and they've already approved stuff, so we've got it ready to go. Also, we will email you a PDF to be uploaded into supplements with your MLS listing for other real estate professionals to understand what the heck a HECM is. For more information or to have this presentation given at your office to your group of realtors, we'd love to do it, and we can do it either live or Zoom, depending on how things work and distances. So just let us know. Thank you very much. Again, I'm Sean Tucker from the HECM Association, and here's our phone number. And if you have any questions, wait, there's that guy, God, man, that guy in the red shirt, always yapping. Go ahead, man.
for some reason, I didn't get the full question for the Lady Bird deed, and I read the typed question. So the second part of her question was, is the loan based on the kids' ages? And the answer is no. It's based on the borrower's ages, which would be mom and dad. There you go.
Important part of the question. Good deal. Glad you went back and read that. All right. Excellent. All right. This is a good time to ask other questions. Come on, people. I know you got questions. Everybody has questions. I've been doing this a while. Everybody, you think you know it, but there's something in your head right now. You're going, God, what would you do with this? Come on.
I do have a question. Well, not a question. You kind of went through some of the contact info slides really quickly. So the marketing slide, like the emails, if you have, need marketing or anything.
Oh, we got all kinds of stuff. It's almost easier to say, for you to tell us what you're looking for, and we'll figure out a way to do it. Hold on, let me see if I can find the slide.
Like I was trying to write down the email for the marketing.
Okay, hold on. Okay. Oh, the
That
email.
one. Yeah,
Where is it? Right?
you just passed it.
This one?
No. No.
There it is. Marketing@hecmassociates.org.
Thank you.
No problem. Good eye. I whizzed by it too fast. All right. Okay, anybody else? Bueller, anyone? Come on. I know you got questions out there. This thing's supposed to be 2 hours long. We're getting very close. All right. Well, I hope you guys learned something. I hope you use this to expand your business in these trying real estate times. I think it is a phenomenal product. I think we are, because we live in Florida and we have so many seniors moving in with pockets full of cash, if you are not using this as a tool, you are missing an opportunity. So there you go. If you have any questions, you can contact whoever set up the class, which I think was Don. It might have been Kathy. Contact me, contact Tim, contact the HECM Association, contact any of us. We will gladly help you, guide you in the right direction, answer any questions, do whatever we can to help out. All right.
Thank you.
Wait. So thank you. And Rhonda, did you have a question?
Yes,
Thank
sir.
you.
How do we go about finding these people?
How do you go about finding these people? I'll give you, I was going to Rotary clubs for a long time speaking, because shockingly enough, Rotary clubs are full of seniors. But that's one way. You can go to senior centers. You can go, there are so many organizations that that are built for and around seniors in every community. There's a huge one. I know you're in a different area, but like in Osceola County has a giant facility that is just a senior facility where seniors go to play games and take classes and all kinds of stuff. And I think every community, for the most part, has them now. Most larger communities have some version of that. If you can get into those and speak to them, if you can go speak at Rotary clubs or in any of those legacy clubs, you will probably end up meeting some seniors. That way, guy in red again. Hold on.
Focus more on those that have paid off their mortgage?
Generally speaking, they're the best ones, the ones that have zero mortgage, but it doesn't have to be. You just about have to be in a position where you have a mortgage that is no bigger than, say, a third of what the house is worth right now. That's the sweet spot, 1/3 or less. So it doesn't have to be fully paid off, but because the interest rates have gone up and put a cramp on our lifestyle, they can't really owe a half or more and have them qualify. Does that make sense?
Yes.
All right. Tim, did you have an answer or a question?
Yeah, let me throw out some ideas. There's no perfect answer to your question about, how do you market? Because a lot of times you sort of fall into something. So to Sean's point, places that are senior rich, not rich seniors necessarily, but senior rich, 55 plus communities. The idea is to get in front of seniors and plant the seeds of ideas. Here's a typical scenario. Most real estate agents, 97% according to NAR, most financial planners, and most everybody doesn't really understand the reverse mortgage program, much less the HECM for home purchase. So you are now the expert in the room. My suggestion is to get out and speak 5 minutes. That's 10. 5 minutes, 10 minutes. Speak in front of a group of people just to plant some seeds. You're not necessarily the expert. You just want to plant the seeds. So let me give you a true scenario. Someone moves to Florida and they have $200,000 cash and they want to buy a home for cash. And the house they really want is $300,000. Now, if anybody at all knew about the HECM for home purchase, it's a done deal. They're buying a $300,000 house. They put $200,000 down. They finance the other $100,000. They have no required payments for the rest of their lives. They're happy, except it doesn't work that way. They go into these 55 plus communities and they have to settle. They either have to settle on a payment for the rest of their lives or just settle on a $200,000 house. So the house they wind up buying is for cash. It's not the house that they want. The house they want is in the newer section of that community. The house they want has a swimming pool. The house they want is been right-sized. It's on the golf course. It's on the canal. It's on a body of water. That's the house they really want. So they wind up settling for something. So if you're able to get in front of a group of people, and maybe it's a group of people that play bridge at the community center of a 55 plus community. If you were just to talk to somebody and say, look, I'm a real estate agent. I just want to speak for 5 minutes about this one opportunity. Don't start paying money, by the way. Don't start sponsoring breakfasts and classes. Don't spend money. You're doing a service. And yes, there's something in it for you, but there's also something in it for them. If you were to plant the seed, how would you like to be able to upgrade your retirement home for no money out of your pocket or virtually no money out of your pocket and get the house that you really want and you still own it without a mortgage payment? End of story. Now, I got a question, right? Everyone's going to start raising their hand. How is that possible? Sounds like a scam. Your point is to plant the seed and get them to call you, and then you can explain the program. Not to be the expert, but then you can refer it to a qualified reverse mortgage specialist so they can explain the program. So let me explain a little bit more. How is that possible? Just to make sure everyone's clear. How is that possible, this particular scenario? Let's just say the house is still worth $200,000. But let's say that they bought it a few years ago. Maybe they put $50,000 down, or maybe they only paid $125,000 for it, but over the years it's gone up to $200,000 in value. Let's just say, in most scenarios, that there's probably $100,000 of equity in this house, which means that when they sell it, for simple math, they get $100,000 cash. You as a real estate agent just sold a house, and you as a real estate agent helped them take their $100,000 profit to buy a house, which means you just made 2 sales because you planted the seed. And now you made a sale on a $200,000 house, but you also made a sale on a $300,000 house. So you increased your commission. Your thinking is, how do you get in front of these particular people that have the ability to upgrade their retirement home, to right-size their retirement? There's plenty of 55 plus communities. There's tons of them. People that live in manufactured homes, you think that they're living paycheck to paycheck and they don't have a lot of money. Guess what? They're living in a manufactured home because they're thrifty. That's all they need. Would they rather live in a stick-built home? Sure they would. Most of them would, but they took the manufactured home route because they're able to pay cash for that house. And manufactured homes aren't cheap anymore. Typically, they're $100,000 to $200,000 for you own the land in a manufactured home park, because it's a 55 plus community. It's lifestyle living. So think about that. You want to be able to do some kind of a speaking engagement to plant the seed. You don't need more than 5 minutes, maybe 10 tops. Just want to plant the seed. And one more time, don't pay. Don't pay. There's plenty of ways to spend money. You don't need to be spending all your money. Look for opportunities for you to come in and just be a quick speaker, just to plant the seed. This right here is a fantastic flyer. It doesn't have to be a real listing. It could be just a sample flyer. But if you have a real listing, even more powerful.
This flyer is fantastic. Honestly, if you had this sitting at an open house, I don't know if you're doing open houses these days or not, but you had this sitting at an open house and you had just wrote in a red pen right here, no monthly payments. You might catch somebody's attention, because you look at that, you put down $130,000, you get a loan amount of that. I don't know if your average person is going to realize there's no monthly payment. It wasn't required. You can make one if you want, but there's no required monthly payment. You might catch a couple of seniors' eyes. It is a huge deal. Or put a sign near it that says, if you're 62 or older, ask me how to do a no monthly payment with these numbers or something like that. There's a lot of seniors out there. And if you can, I'll say this, they're like a lot of other demographics. If you get in with a couple, they will refer you because you treated them well, and they will refer you to their peers. So I guess the answer there is always treat them well, and you'll get business out of it. It's a good deal. All right. Anybody else? All right. Well, I will go through the roster of everybody that showed on the that they attended today, and make sure you get your CE credits. I appreciate your time. Thank you for listening and looking into this product. You've been great.
Thank you so much.
Other than that, you were great. Go ahead.
Thank you.
Thank
Thank
you.
you.
I'll just
you,
say thank
guys.
you. Have a good one.
Thank you.
Thank you. You too. Have a great day.
Nice job, Sean.
Thank you. How do I get the list of people?
Good question.